Good morning, everyone.
Morning.
Good morning. It is government employees.
Morning.
Regular meeting of the Board of Trustees for Thursday, April 24th, 2025. Is hereby called to order. Roll call, please, Mr. Dawson.
Yes, Mr. Chairman. Trustee Tom Clark.
Present.
Trustee Clark present. Trustee Andre Dorsey.
Present.
Trustee Dorsey present. Trustee Vincent Liger. Trustee Liger absent. Ex officio member Cindy Richardson.
Present.
Ex officio member Richardson present. Trustee Ronald Russell. Trustee Russell absent. Trustee Leona Smith.
Present.
Trustee Smith present. Trustee Dwayne Colwood present. Trustee Colwood present. Mr. Chairman, 4 present, 2 absent.
Thank you, Mr. Administrator. Do we have any comments and suggestions from retirees? Do we have any comments and suggestions from active members? Okay, at this time, trustees, I'd like to have a motion to reorder today's agenda. We have Makita, our investment advisors, joining us to do a partial presentation of the investment report. However, they're working with some time constraints. So I'd like to have a motion to move the investment officer's report up to number 5, ahead of secretary's minute.
So moved.
Second.
Moved by trustee Dorsey.
Yes, Trustee Clark.
Yes.
Trustee Clark, yes. Trustee Dorsey.
Yes.
Trustee Dorsey, yes. Trustee Liger, absent. Trustee Russell, absent. Trustee Smith.
Yes.
Trustee Smith, yes. Trustee Colwood.
Yes.
Trustee Colwood, yes. Mr. Chairman, 4 yes. 2 absent.
Okay, thank you. The motion is adopted. So at this time, we'll move to the investment officer's report, and I will invite our representatives from Makita to make their presentation.
It's there.
Yeah, I don't see.
Good morning. I think Leo may have dropped for a second.
Just log back in. He just came up in.
And does Mr. Henderson actually have the report? So,
Yes. Go ahead, Leo. The floor is yours.
Right, good morning. Sorry, I was having issues. I had to disconnect and connect back again, and now I can hear everybody very clearly. Can you hear me well?
Yes.
Great. All right, so I don't know what you said, but I'm assuming you want us to go over the materials we have sent you for this meeting. Is that correct?
That's correct. Leo.
Yes, that's
All
correct.
right. If we need to pull something on the screen, Sean, are you able to do that? If not, I will point to page numbers.
I can pull it up if requested.
Okay. I'll start making some brief commentaries about the first quarter. Our materials have information as of March 31st. Obviously, a lot has happened since in the 3 weeks that followed, and we'll provide a verbal update where possible. So, contrary to what happened much of the last few years, U.S. stocks were down for the first quarter, with the broad stock market losing just south of 5%. The areas within the U.S. stock market that fared better in the past few years, the larger, growthier companies, suffered the worst losses. Those were about 10 to 12% down. On the other hand, areas that had weaker performance in the last year or two, such as stocks overseas did better. For example, stocks in other developed economies, as in Europe, Japan, etc., combined earned about 7%, and in emerging markets about 3%. An important driver of that performance, which we measure in US dollars, has been a weakening of the dollar. So in local terms, European, Japanese stocks were up about 3%, but there was a 4% gain when you translate foreign currency into the US. In emerging markets, the performance gain was not driven necessarily by changes in currency, but by a rally in Chinese stocks, which during the past year has been pretty strong. Also, during the quarter, there was no activity at the Fed. In other words, no changes in the level of interest rates. Given some of the uncertainties in the economy and concerns with growth, bonds did quite well as interest rates came down. So the broad measure of bonds gained about 3% for the quarter. Longer duration bonds gain about 5%. And credit-related bonds, such as high yield, gain about 1%. So overall, a strong quarter for most asset classes except U.S. equities. And you can see that on the second page of our materials. Most are to the right, except for U.S. stocks, which had losses, and most of those losses happened in March. And that trend continued through April, although there's been wild swings in the markets, with some days showing strong gains and other days pretty meaningful losses.
Half a second.
Pause. Sean, are you supposed to be projecting the presentation?
I can if asked. I no one asked me. Let me add it. Apologies.
Good.
Great. So I was referring to this page. So on the left, you'll see the first quarter, most asset class from bonds, commodities, stocks overseas had gains. US stocks had losses. This is normal. Usually there is an area of weakness. Some years it's going to be commodities, other years it's going to be bonds, sometimes it's going to be stocks in one geography or one type of a stock. So this is not unheard of, and the level of gains and losses is still within reason. What it hasn't been within reason, and it has been a bit of an outlier, has been the wild swings that we have experienced the last few weeks. Those have been more along the lines of the swings that we have experienced during the Depression time, during the crash of 1987, during the global financial crisis, during COVID, during real times of stress. We're not seeing that in the results because one day the market goes up, the other day goes down. It moves less when you compound over a number of weeks, whereas in those environments, it was either moving up or down consistently. So we're seeing increased volatility and some losses, but I would say the losses have not been broad, have been concentrated in a few areas. If you move over one page, we'll dig in a little deeper into the U.S. equity returns. As you can see, March was a difficult month, no matter where you look. During the quarter, you'll see Russell 1000 growth, essentially the segment that Russell indices considers to be growthier. So the largest 1,000 companies, a carve out of that, the more growth-oriented companies lost about 10%. And in the 2000 space, essentially the next 2,000 companies that are categorized as being growthier lost about 11.1%. On the other hand, large value companies, financials, energy, utilities, and such gain about 2%. So it hasn't been losses everywhere, but it's been losses mostly where stocks have done well in the past year or two. And you can see that reflected on the next page when we look at sectors. So technology, consumer, those were hit pretty hard, losses of in excess of 10% for the quarter. On the other hand, you look at utilities, telecommunications, energy, those have been more defensive sector, financials, etc., that had posted gains for the quarter. Overseas, if you look at the third row on the next page, you'll see EFI, local currency. During the quarter, you see a gain of 2.9. I mentioned that earlier. So that is what the local economies did, but then you have to adjust for us to bring those back into US dollars. So we measure everything in the same currency. And when you do that and the dollar depreciates, the return of those assets overseas is worth more because it buys more dollars. And so the gain for the quarter was 7% overseas. And that's why it helps a system like GERS to have a diversified exposure of the stocks globally. Because usually some will not work, but the rest will, and those will offset the losses for those that are not working during a given time. At the bottom, you see China at 15%, and that has been the source of the returns for emerging markets, as the rest had been mostly flat. On the next page, we look at valuation, and not much has changed. If you look broadly, you see pretty rich valuation for U.S. stocks. That's the top line. The average is the flat line of the same color, so we're above it, so quite meaningfully. So stocks have done very well the last couple of years following 2022 and reached pretty strong valuations. And overseas, less so, is either at or slightly below historical averages. So usually valuation is very insignificant predictor of performance in the short term, but in the long term, it has some merit. And so this tells us that there is likely, over a very long time horizon, better likelihood of strong performance coming from overseas, as you expect some reversion to the mean in terms of valuation, especially in the US. On the next page, we look at fixed income. And there you see a very strong quarter as interest rates came down. That has somewhat changed during the first few weeks in April as interest rates have risen. And so we have seen bonds post some level of losses depending on where you look. But the broadest measure is the Barclays, or now called Bloomberg Aggregate Index. That gained just south of 3% for the quarter. Strong performance had been TIPS, which are Treasury securities that are adjusted for inflation, and those gain anywhere between 3 and 4% depending on the length of those bonds. Some bonds have 1 year to maturity, others have 20 or 30, so it really depends on where you're looking for. But in general, that has performed quite well. And continuing on bonds, we look at interest rates. This is for treasuries. And if you look at the left side of the yield curve on the next page, the green is how it looked at the beginning of September of last year. And we picked that month because that was the month that the Fed decreased interest rates and began to cap. And we now end on March 31st, 2025, and you see that drop. On the left side of these charts, it dropped from over 5% to just somewhere over 4%, 4.25% to 4.5%. And so those brought down essentially the cash rates, and that's what the Federal Reserve can manage and influence directly. As you look to the right on this chart, it's mostly reflective of market dynamics. And what you see is not a lot has changed during these 7 or so months. And in fact, if we were to look today as interest rates went up, what you see is a more normal shape of the curve where longer maturities have a higher yield than shorter ones. The green one is called an inverted yield curve, and that is usually during times of distress or negative expected economic environments, as the yield curve has often, but not always, been a predictive source of a recessionary environment that we're about to face. On the next page, as we build on that thought of are we in a recession or are we going that way, we'll look at the consumer as it represents over 2/3 of the economic force. And what we notice is an uptick in delinquency, not to the point suffered during the past recessions, If you look, for example, at the global financial crisis in 2007, 8, and 9, you'll see big spikes on the chart on the left. Even if we go to the 2020s and we look at COVID, we're doing better. It's just that the last couple of weeks, marks, it has been going up. On the chart on the right, we also see that over the last few years, the delinquency on credit cards by age is going up, primarily over those that are younger in age, just under 40. We're still not at a level that would suggest we're in deep trouble, but it is increasing and it's something we're monitoring. Unfortunately, a lot of metrics are backward looking. And so once we can realize and see where we are, it's usually late, and that means we may be already in a recession. So some of these are lagging indicators, but nonetheless, we try to monitor and see where we are on a variety of metrics. Just about to wrap up this section, but the next couple of slides look more at the economy. Before we go there, on the next page, we look at the spreads. So we were looking at treasuries. Now we look at other fixed income securities. So if you look at, for example, high yield, which is credit of companies rated BB or below, essentially companies with that have to pay quite a bit more than the government to entice investors to buy their paper. In that case, during the quarter, you'll see a spike in yields from 2.9 to 3.5%. So you see that red line tick up a little bit, still below historical averages. So in other words, you don't get paid as much as during average times to hold this kind of paper. During times of distress, you'll see those spike. So if you go back through 2008, you see it go to almost 20%. So you need to offer a lot in terms of yield and returns for any investor to take your paper during times of financial stress and distress. We're not there, but we've seen an uptick, and it's normal to have movements up and down. It is when they're consistent and of large magnitude, as we've seen in 2008, for example, or 2020, when we can tell that, hey, this is a time of that market participants feel they need to be very conservative, and so there is a shortage of buyers of these securities, and so the price needs to go down to entice a better participation by investors. On the next page, we look at market volatility. What I can tell you is that, yes, it has increased both on the equity and fixed income markets during the last quarter, and that trend has continued during April. The next couple of pages look at inflation and unemployment, which are big areas that the Federal Reserve Bank looks. Inflation has continued to come down. Recall, it's a 12-month moving average, and so each time you add an observation, you drop one, the one from 12 months ago. And so it takes a while for any changes to be noticeable. So in this case, as it is the cases in the US and most of the rest of the world, inflation is coming down from a period of stress after the onset of COVID, where supply chains hit some issues and inflation peaked in most of the world's economies a couple of years ago, and it has been since coming down. So you see that on page 15 and 16 of our materials. Japan is the only exception where inflation has actually moved up. They had been moving somewhat contrary to most other economies. Unemployment remains pretty good by historical context at about 4.2%. Not much to tell from this picture. We also show a different measure of unemployment. It's a broader measure, the U6, that includes those that may have jobs that are not the ones that they are qualified for. And so that one shows at about 7.9. So if you look at those lines compared to historical averages, doing pretty well and pretty stable over the past few years. I have 2 more pages to go. We're looking at policy rates by the major central banks around the world. Most have been cutting rates for the past year or so. The US has hit the pause in the last quarter, and it's remained flat at 4.25% to 4.5%. Others have continued to cut during the past few weeks. and the Japanese has been the one continuing to increase. So recently, I think they increased it one more time to another 25 basis points. Lastly, the dollar has shown weakness the past couple of months. That has continued through yesterday. And so we are seeing the dollar measured against a basket of broad currencies, roughly 10 of those, are coming down from a little over 110 at its peak around 2022. Right now it's about 100. So that has been a factor in other developed economies doing well when you translate those into US, as I mentioned earlier in this presentation. Let me pause there, see if there's any questions on the markets. The rest of the presentation, looks at your specific performance, and it has a bit of history as to the changes made and how that has impacted GERS. But overall, the fund is holding up quite well given its diversified exposure. And so we can go into that in a few moments if you have no questions on the broad markets.
Are there any questions with respect to the broad market? Hearing none.
We'll continue, and then if some questions come up, we'll address those then. So if we move to the next section, you'll see that you're very close to your policy. Recall a number of months ago, we changed that policy collectively to pare back the equity exposure by 10%, move that into fixed income. So that was done towards the end of last year. And it was a right call. Obviously, it wasn't done because we were able to time the market or see a deterioration in performance, but it was done primarily as we looked at your specific situation, looking at cash flows coming in, looking at the amount of money needed to pay benefits and expenses, and looking at projections from the funding node, putting all of those things into consideration, led us to take a slightly more conservative stance, and so far it has been a good move, as equities, particularly in the US, where we took that money from, had been the weakest performer. We take advantage to rebalance the portfolio typically every month or every other month at most. Usually you need to draw money to pay benefits, and so we usually sell those positions that have done the best. And that usually it's enough to get you back to par. And so as we have to do the next one, we'll be doing the same. Right now, foreign stocks and bonds have done best. US stocks have done weakest. So we're likely going to be taking money from those positions that are slightly overweight. What you can see is your largest exposure is to the US stock market at about 35%. Then you have another 20% or so to stocks overseas. 15 of those in developed markets, and about 5% target into emerging markets. Then you have about 20% in high quality bonds, including a mix of treasuries, high quality credits, mortgages. That's the lion's share of that 20%. Then you have another 10% in treasury inflation protected securities called TIPS, 10% in high yield bonds, which are credits rated BB and below. So those are somewhere in between the stock and bonds in terms of expected return. And then you have a very, very small position in two private equity fund of funds under the alternative assets under 5 million. Those are on their way out. They are in liquidation mode. They've been coming down. They've done well, but they essentially are insignificant compared to your portfolio, about 1%. And again, as a reminder, this does not include valuation or any metrics for your local assets. Let's move into the next page, Sean, please. Here we have a historical snapshot at your performance. So as you recall, when we met at the retreat in July of 2022, can you go back one page? Thank you. At that time, the fund had been being depleted of assets to pay benefits, and we had been selling stocks and bonds, and at the time we had had a small amount of bonds and cash on the account to pay benefits for just a couple of more years, as the fund was projected to hit insolvency sometime around now, 2025. The funding note came into effect and provided 3 years of contributions that were supposed to be 158 million approximately. And so with that money coming in, plus the promise of additional contribution at different levels over the next 30 some odd years, caused us to revisit the whole asset allocation exercise and move to a more traditional asset mix for a pension fund that at the time was moved from essentially cash and high quality bonds 50-50 to 65% stocks and 35% bonds. And so you'll see that big change where we put money into equities, and you'll see that on the blue line, developed markets equity, that's green, etc. And then if you go all the way to the right and you look at the year end of December 2024, that's when we took 10% from stocks in the US. The blue line went down and the orange went up, which is investment grade bonds. So right now, again, you're at a 55-45 allocation in terms of stocks versus bonds.
So can I jump in, Leo, and ask a quick question here? So based on the asset allocation history, we're a little bit underweight US equities from where we first started. And as you eloquently stated, we had made that decision back in November. So, I think that there's a good basis for not timing the market, but making prudent decisions relative to risk. What do you see as, potential asset allocation shifts in the future, given just the state of the market volatility? Do you think these levels are good from a US equity perspective? Or, should we be looking at potentially even lowering our US equity allocation in the future, since it was prescient to do so back in November?
Good question. The primary considerations back then were not necessarily market conditions, although they were a factor. Recall that I had stated that valuations were pretty rich. And so if you really look back at performance in the past few years, even the last decade, yes, stocks did very well, in some cases pushing 20% gains per year, every year during the past 10 years. And that is not sustainable. So either we made up from underperformance in the past, or we borrow performance from the future. So that was one small aspect. The other one was more unique to the system. Recall that we had only 3 years of large infusions from the funding note at about 158 million each. And after that, we have about 12 years or so of more muted contribution of roughly 80 million. So we knew quite well that the first 3 years were the strongest, where we needed to try to capture the most returns. And then from that point on, we need to be on a very watchful mode, as the contribution that is coming in, the 80 million, is insufficient to meet the deficit between the money coming in and the money going out to pay benefits. So we know we're going to be drawing from the fund. So if we take wild swings in the market, that's going to be negative to the value of the fund, because if the markets go down and we need to sell to pay benefits, then we just can't recover. So percentage returns don't matter too much when you have a lot of money coming in or money going out. Is the actual dollar return that matters. And so from that perspective, we felt that it was prudent to pare back equity. And because US equities had done so well, that was the primary, or I guess the only source a few months ago when we cut that back. If I look at your exposure to US equities versus peers, you are within range. So we're comfortable where it is today. I don't think we need to increase it anytime soon. We'll continue to monitor the situation. And if at some point in time they became attractive from a valuation perspective, we have better views on contributions from the funding node, etc., then we will reassess it. I think when we meet again in person at the July, we'll spend some time looking again at asset allocation. I don't know if it will lead to any changes, but it's something we will review at least on a yearly basis.
And tariffs are a big issue. At that point, do you think that we'll have clarity on what tariffs look like so that we can make a educated decision, because if there's a lot of uncertainty, it would promote a lot of volatility in the U.S. equity market. So if we have more certainty, will that help us make a better decision for our asset allocation?
It's hard to tell how much more clarity or not is going to be out there in 3 months. We're not typically setting portfolios for the next 3 months or 4 years of the next administration. We usually set it for a multi-decade period, and there's a lot of things that can change during a time like that. So from that perspective, I don't think visibility on tariffs or clarity will be a determinant factor. It may cause the market to move in a certain direction, but beyond that, I don't think it's going to be the primary determinant for us to consider making any changes to the way GERS portfolio is allocated today.
Thank you.
Okay, let's move to the next page, Sean. So here we look at performance, and for the quarter to date, we had a small markup in the portfolio of about 50 basis points, or 0.5%. Recall U.S. equities lost about 5%. Everything else was up, but U.S. equities is a big portion of your portfolio. And so overall, a decent quarter given all that was happening in the market. For the fiscal year today, we were flat essentially. As the fourth quarter of 2024, the first quarter of the fiscal year was negative. This one was positive. So not a lot of market gains. Do recall that the prior 2 fiscal years were very strong, with one generating returns of 20%, the other one about 8%. So overall, if you compound the returns since the time you changed from essentially a cash account to a more standard pension fund type of investing, you have done quite well and significantly in excess of your actuarial return of 6%. The fund remains invested in passive, very low cost index funds that allows for daily liquidity, ease of movement, exposure to the broad markets at essentially a fraction of the cost. So very, very efficient from that perspective. The exposures essentially match the asset allocations that we went over 2 pages ago. If you go over to the right, one more page, we look at the actual holdings. Thank you, Sean. So you'll see, roughly 35% in stocks, a combination of large and small. And then you see one index for developed markets at 15.4%, another one for emerging, and so forth. And you'll see the performance of those. We can skip the next page. Yeah, go ahead.
As if everybody froze. There must be an hour in.
Okay, Leo.
Okay. Are you okay now?
Yeah.
Okay. Let's continue, Sean. One more page. So this is what I meant earlier. So if you look at fiscal year 2024, the fund made 24.3%. That's about 4 times over the actuarial return. So essentially those gains, are amortized in future years, and that's good. It improves your funding and financial status. Fiscal 2023 was also good, more moderate, 8.6. The goal is to compound returns above your actuarial rate of return on average over a full cycle, or as long a history as you can. So we know there's going to be tough years. For example, 2022 was a year where you couldn't hide. Stocks went down roughly 20%. Bonds went down roughly 10%. You were pretty conservatively positioned, so you did better than most of your peers, but you still lost 10%. Plus, you didn't make the 6% you were going to make. So that was a tough year with that, it cost roughly 16 percentage points. If you continue looking to the past, you'll see pretty stable performance in most years ahead of that 6%. And if you were to look back since inception, us going as far back as we can, you're well ahead of that 6% metric. So on an investment measuring point, the fund has done what it was supposed to be doing for many, many years on average. And that's what we want to see. We can skip, let's see where we are. We can go to page 32, looking at fees. So you had 437 million as of the end of March, just for additional perspective. That figure as of yesterday was about 430 million. So a bit of a decline. A couple of days prior, it was much worse, but we had 2 good days that performance recovered. And so how much you pay for all of this? It's about $100,000 or about 3% of 1%, 3 basis points. So overall, it's a very, very small amount that is being paid to get this portfolio invested the way we want it to. That's very efficient. 2 pages forward, we look at your private markets. You had 2 funds. These are from 2006 and 2009. This is something that had become quite common for pension funds to do, to invest in private equity. The stocks that trade in the Nasdaq, in the New York Stock Exchange, are a fraction of all of the companies out there. Most do not trade in the public market. Most are privately owned. And when interest rates went down and expected returns for a lot of assets went down, this was one area that a lot of investors felt could produce the returns needed to get those actuarial returns that were needed by them. And so over the past 20, 30, 40 years, private equity went from a very small asset class to a very material one, an important one for most pension funds. So GERS had some exposure early on. Those investments did quite well, but for cash flow reasons, for liquidity reasons, as the fund was trending towards an apparent insolvency, we just were not able to invest in these type of assets just because they had a very long life and there was not enough visibility that liquidity, that money invested to these funds would not be needed sooner to meet benefit payments. You do not have any control as you do with your stock and bond investments that you can place a redemption. Here you can. The manager retains that control. And so for that reason, we stopped making these investments. But if you look at your experience has been positive, you've compounded gains at about 11% on your first investment and 15.7% on your second one. You put to work 14.7 million in 2006, and that vintage year, you already received 26.7 back. So that means your recovery of 14.7 and added about another 12 million on top on gains, and you have about 1.5 million left of value that eventually will be returned to you. And then on Fund 5, you put to work 9.5 million that the manager called to invest. You received that plus another 10 million for a total of 19.5, and you have 3.1 million worth of value. So combined 4.6 million, little over 1% of the assets of the fund, excluding the local assets. So overall, a good experience. At some point in time, even when financial situation for GERS improved, this would be something we would look back to consider making investments. But for the time being, it's not something we can do.
Leo.
Yes, sir.
Thank you for the presentation. And of course, we've also seen a lot of this in our investment committee. We thought it would be good to have you and Sean here today in our board meeting, since we have a wider audience, and we felt that it would be good to share this information more broadly. So that being the case, we do have various levels of interest and experience in this meeting. If you were to sum up our performance presently, because folks are hearing about a lot of volatility in the market, so it would be natural that there'd be concern. But I think one of the things that you said is that we're seeing wild swings that are sort of canceling each other out over the course of the last month. How would you, for the sake of lay people that may be present in this meeting, characterize our portfolio at present?
Yes, I would say that the fund has performed relatively well. We're very happy with the way the fund has performed. The fund is not invested to profit from daily movements in the markets. Instead, we position the fund to succeed in a variety of environments with a long-term horizon in mind. The objective of the fund is to make over 6% per year on average over a period in excess of 10 or 20 years. We have been doing that by and large, despite the difficult times that we face. For example, there was a number of years we were primarily invested in bonds and cash, and it's not that easy to do it when interest rates are zero. We had headwinds during COVID. We have headwinds in 2022. If you go back to 2008. So despite difficult environments, the fund has been able to do that. If I look back at the longest data point since July of 1981, the fund made 8.4%. Reassured by seeing that we had, spent a lot of time thinking about this fund and what to do given the unique circumstances affecting it. And we made some changes in 2022, additional changes in 2024. Those have worked out well. And obviously, we don't have a crystal ball, but we were fortunate that the market, helped us. So we spent collectively a lot of time trying to position GERS in the best possible way for the future. And we were the recipient of some good alignment with the way the market has functioned in the way we were positioned. So from that perspective, we put money into the equity market, and it was pretty close to the right time to do that at the end of 2022. And then we took some of that out at the end of 2024, and that was before, in somewhat of a correction in the U.S. equity market. So from that perspective, things are working out well. We cannot be moved by any daily changes in the markets, but we use that as an opportunity to rebalance. And so each time the market gives opportunities, we take advantage, we rebalance, and we continue to position the portfolio for the future success of GERS over a multi-decade period. And so from that perspective, I would say we're very comfortable with the positioning of the fund and happy with the result we have seen over the past number of years.
Excellent. Thank you so much. And to pick up on a question that was that Trustee Clark began to ask, if you were to quantify on a high level what the impact of the prescient or timely changes in our portfolio allocation has been in 2022 and 2024, particularly, what would you say that quantification represented in terms of?
Yeah, Sean calculated that yesterday. I haven't memorized it, but Sean, I think you had some estimates. Can you share those with the group, please?
Yes. So we looked at two scenarios. So when we initially moved in October 2022, late October 22, from the bonds and cash portfolio to a more traditional asset allocation, redeploying into equities. For that period, the system has gained, so from November 1st, 2022 to March 31st, 2025, about 3.1% net of fees annualized. And if the system had remained 50-50 bonds and cash, we estimate the return would have been significantly less at about 5.2% annualized. So that was a strategic decision that has benefited the system. Then the other one that we talked about at the end of November 24, we reduced the equity exposure by 10% and added it to high quality bonds. That was about a $50 million transfer. And as Leo had mentioned, after that implementation, the US equity stock market lost about 7.5%, while investment grade bonds gained about 1% in that period ending March 31st, 2025. So that has provided some downside protection as well. So two positive moves by the trustees.
Excellent. We need to keep that crystal ball well dusted. Thank you.
Anybody have any questions for Makita with regard to the presentation thus far? All right, hearing none, thank you, gentlemen, for the presentation.
Thank you, everybody.
Thank you.
Thank
Look
you.
forward to seeing you soon.
All right,
Bye.
Mr. Henderson.
Yes, Mr. Chairman.
Okay, so I believe you have a presentation to make, I guess, that would include the local asset stuff outside of the investment portfolio.
Since Mikita primarily covered most of the performance for the quarter, just a second. I would add, if you recall, Mikita did mention that they do not report performance on our local assets. So if you take our local assets into consideration, our fiscal year return so far would be 1.3%. And that's primarily based on the performance of the Havenside Mall, the recent appraisal, and also the cash flow activity from beginning of the fiscal year to present, or at least until March 31st, 2025. So as you know, the Havenside Mall has pretty much no correlation to the overall stock market performance. So that has been a very good performing asset for us so far for the year. Other than that, I would speak to the cash flow for the month, just to tie it all together. So we ended at approximately $505 million at the end of March. We had a beginning market value of about $345 million. We had a net cash flow of about $20 million to pay benefits. We had income of about $189,000. We had an unrealized depreciation in the portfolio of about $9.5 million. That brought us to an ending market value of about $505 million. If you look at the fiscal year to date activity, we began the fiscal year to date at around $497 million. Fiscal year to date, we have a net cash flow of about $1.5 million, income of about $1.2 million. We have an unrealized appreciation in the portfolio of about $5.6 million. That brings us back to the market value of $505 million. And again, this $505 million includes what Makita just reported on, plus our Havenside operations, and also our local lands. In the month of March, we did raise $19.5 million to replenish cash to be able to pay benefits. We took $8.5 million from the MSCI EFA index. We took $6 million from the US aggregate bond index, and we took $5 million for the US tips. So as Leo stated, we've been using those indexes that have been performing well to rebalance the portfolio. As it pertains to investment management, custodian, and consulting fees, we didn't pay any fees month to date. So far, year to date, we've paid about $125,000. Fiscal year to date, we've paid about $224,000 in fees. And as Mikita has also mentioned, we continue to have great performance and with minimal cost as possible, as this is a very, very low cost portfolio at about 3 basis points. Mr. Chair, trustees, that's about it.
Thank you, Mr. Henderson. Any questions for Mr. Henderson? Okay, can I have a motion to accept the investment report?
So moved.
Second.
Moved by trustee Clark, seconded by trustee. Roll call.
Yes.
Second.
Yes, Mr. Chairman. Trustee Clark?
Yes.
Trustee Clark, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Liger?
Yes.
Trustee Liger, yes. Trustee Russell? Trustee Russell, absent. Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Colwood?
Yes,
Trustee Colwood, yes. Mr. Chairman, 5 yea, 1 absent.
thank you. Okay, next up, we have the secretary's minutes from the regular meeting, the March 21st, 2025 meeting. Are there any edits or corrections to be made to those minutes? Hearing none, can I have a motion to accept the minutes from the March 21st, 2025 meeting?
Moved.
Second.
By trustee Clark, seconded by trustee Dorsey. Roll call, please.
Trustee Clark?
Yes.
Trustee Clark, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Liger?
Yes.
Trustee Liger, yes. Trustee Russell? Trustee Russell, absent. Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Colwood?
Yes,
Trustee Colwood, yes. Mr. Chairman, 5 yea, 1 absent.
thank you. Are there any communications, correspondences to be read into the record?
No, sir.
So the chairman's report. Okay, so let's take a 2-minute recess. Okay, all right, go back on the record. Next up, we have the administrator's report.
Yes, Mr. Chairman. As usual, I'll begin with abridged meetings, presentations, and appearances. March 25th, I attended a meeting with the Office of Collective Bargaining regarding an ongoing matter. March 25th through 28th, we continued our efforts with Vitek and Linnea with regards to our migration from version 8 of the V3 system to Velocity. That's quite an undertaking. March 31st, we had the transfer day holiday. April 1st through 4th, I was on personal leave. April 7th through 10th, in my capacity as head of GERS and Havenside Mall, specifically oversight responsibility, attended the Sea Trade Cruise Global convention to introduce our property manager, Mr. Emmett Mills, to the conference, given our ownership of the Havenside Mall and our involvement in the cruise tourism industry in that regard. Attended a number of very insightful meetings at the conference, which I have listed here. I won't name them all. And have now turned that endeavor over to Mr. Mills, who will represent the Havenside Mall going forward at the Sea Trade.
You seem kind of happy talking that.
Yes. April 9th, we were in the midst of the throes of the tariff announcements, and Makita facilitated a webinar, which we were invited to and attended. The name of it was Markets in Motion. I think it was the day after Liberation Day when everything was going haywire, and to some extent continues to do so. April 15th, participated in a Velocity Migration Executive Committee meeting, actually chaired the meeting, it's my group. And April 16th, participated in a business process improvement session with Linnea, in that we're not only migrating our pension benefit system, but we're also taking the opportunity to review all of our business processes and to improve our business processes wherever possible. Continuing on with my reports, member services, retirement applications. In 2025, or for 2025 rather, we have 72 applications remaining, 156 altogether, when you include prior years that are being processed. Contributions processing, refunds, and death benefits. Thus far for the year, we have refunded, actually this is for, so this is through March 2025, right? We have paid out $149,833 in refunds, most of which represent regular refunds. That's 168 units altogether. Death benefits, we have probably 65 cases pending, and we've completed 2 cases totaling some $53,000. Annuity payments, Ms. Jeremiah will cover this in her report, but we have paid out some $607,26 in annuity payments. We As of the April 15th payroll, we have 8,776 retirees. The number of retirees added to the payroll in October, well, for October 1st through April 15th for the fiscal year has been 164. For the pay period ending, or for the pay period of April 15th, 30 were added. We expect to add another 17 on the payroll of April 30th. We have deleted 159 retirees from the payroll. Of course, sadly, that's due to death. And once again, we're almost deleting as many as we add through natural attrition. The semi-monthly retiree payroll has arrived at $11.3 million. We have, on a monthly basis, 9,443 disbursements, of which, once again, the vast majority are in the Virgin Islands, 7,725 versus 1,718 outside the Virgin Islands, which once again shows the importance of the GERS as an economic pillar in this community. The loan portfolio, the loan unit, we have, in terms of personal loans, 2,261 active, personal loans in our portfolio. We have our legacy mortgages. So between loans and mortgages, we have 2,328 loans outstanding. I would take this opportunity to share that we continue to make progress in preparing for the limited restart of the retiree loan program. We're in testing right now of the loans module so that we can accommodate the retirees. There'll be a press release going out with regards to the timeline, but that definitely will be an early summer start. So we're looking at starting the first appointment somewhere in June, but in the month of May, which is almost next week, we'll be sending out a press release with the information for retirees. As we spoke about our investment performance, Mr. Henderson did speak about our local assets, and it's not only the Havenside Mall, but we also have our loan portfolio that is giving us a guaranteed 8% return and well secured, also assisting our active members and the community at large as we support the economy. I imagine that we'll have a similar outcome for the retiree loan program. And at this time of volatility in the financial markets, a guaranteed 8% return for essentially a fully collateralized loan is quite attractive. So we have some self-interest in doing these loans as well, as it does very well for our portfolio as well as for the community. Continuing on, as far as operations are concerned, we have no major operational issues. We have basic upkeep of our complexes, both on St. Thomas and St. Croix. Of course, it's exciting to see the Hampton and Hilton at Hampton by Hilton at Havenside, try saying that quickly, coming to fruition. Everyone has seen the exterior, but I'm happy to report that the work on the interior is progressing quite nicely. We have some photos up showing the progress with the interiors, with the interior. And once again, getting back to our investment performance, Mr. Henderson did indicate that we have received good return. It's short of our return, frankly, at the Havenside Mall in these very volatile economic times. Because of the work that we've done at Havenside, as well as the imminent opening of the hotel, are looking at a value of about $58 million appraised for Havenside, which is an increase of some $17 million over 2017, I believe was the, or maybe it was 2021, was the last, 2017, I had it correct, was a prior appraisal. So that's like a 47%, 43% increase in value over a relatively short period of time. So that continues to be a very sound investment, and it falls under the caption of alternative investments. And we see the value of alternative investments when we have the volatility in the financial markets that we're seeing presently. So, Mr. Chairman, that would conclude my, of course, we have our usual update on rentals and utilities. Nothing really new to report here. We have the Department of Justice that owes us some $222,000 for rent and utilities. I must say, kudos to the Division of Personnel. Director Richardson, are you on there still?
Yes, I'm here.
We thank you for being current.
You're welcome.
With your rent and utilities. Thank you so much. We have some very minor delinquencies in our with our one of our private tenants on St. Croix. The bulk of our arrearage is in fact the Department of Justice. We continue to work with them to get them current, hopefully with the government's cash flow, hopefully having improved with tax day last week. We might see some action from the Department of Finance. So with that, Mr. Chairman, that concludes my administrative report.
Any questions for the administrator? Okay, so let's move on to the committee reports. The investment committee met on Tuesday, April 22nd. We got an update from Makita, our investment advisors. A compressed version of that presentation was made earlier by Makita in this meeting.
Actually, today's felt longer.
Yeah. That's true. I believe that's it with regard to committee reports. We'll move to the treasurer's report, Mr. Amaya.
Good morning, Board Chair, other trustees. This is the Government Employees Retirement System schedule of receipts and disbursement for the month ending March 31st, 2025. Receipts from collections, loan repayment, $610,000 year to date, $3,948,960. Rent from tenants, $47,000 year to date, $500,000. Employer retirement contributions, $8.3 million year to date, $46.5. Employee retirement contributions, $4.2 for the month of March, year to date, $23.7 million. We have a total collection of $13.1 million, year to date, $178 million. Our disbursements, we have annuity payments of $22.9 million for March, year to date, $139,769,000. Our administrative expenses for the month of March was $1.8 million. Year to date, $9.4. Our refunds of contributions for the month of March, we have 599,088, 5.3, for a total disbursement in March of 24.6 million. Year to date, 154,677,000. Net cash deficit for March was 11.5 million. We had a surplus of 23.4 million year to date. We have used 42% of the budget thus far for administrative expenses.
Excellent.
Going on to Havenside Mall. The Havenside Mall received from collections. We have rents from the tenants of 609,000 year to date to 3 million. We have miscellaneous collection of 39,000 year to date, 226. For a total collection for the month of March of 649,000 year to date, 3.2 million. We have disbursement totaling 484,000 year to date, 2.3 million. For a net cash surplus of 164,000 in March and year to date, 829,000.
Excellent.
And that's it for the Havenside Mall. I think they use like 29% of their budget. That's fine. So that's it.
We run a tight ship.
Good job, Mr. Chairman. Keep them on the short list.
Mr. Mills?
I'm listening. We do run a tight ship, sir.
Kudos, very good at expense control. We did have an incident this week where we discovered a sizable leak in a water line. Fortunately, a water leak. Fortunately, it occurred. Unfortunately, it occurred after our meter and not ahead of it. So we have to discuss. We're in the process of having that repaired. Mr. Mills, since you're on, maybe you can give us a quick update on that.
Absolutely. We had WAPA come in and they repaired the pipe. So the property is now back on full pressure. We were noticing low pressure coming into the property, which kind of hinted to us that there was something that we needed to fix, and we got the assistance from WAPA to come in and help assess that situation by putting ground mics and locating where the leak was. So they were very instrumental in assisting us yesterday and patched the pipe up, put new pipes in, and now we're fully operational again.
Thank you, Mr. Mills. And just one final note, I mean, the great financial report that Mr. Jeremiah just gave is before we started to collect any rent from the ground lease for the hotel, which, as we know, entails a portion of their revenue. So we're looking forward to even greater performance from Havenside once that cash stream comes online.
Any questions for Ms. Jeremiah? Have a motion to adopt the consolidated treasurer's report.
Moved.
Is there a second?
Second.
Moved by trustee Clark, seconded by trustee Smith. Have a roll call, please.
Yes, Mr. Chairman. Trustee Clark?
Yes.
Trustee Clark, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Lighter?
Yes.
Trustee Lighter, yes. Trustee Russell? Absent. Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Colwood?
Yes.
Trustee Colwood, yes. Mr. Chairman, 5 yea, 1 absent.
Thank you. I have a motion to go into executive session.
So moved.
Second.
Someone has a narrative?
Yes. Another motion to go into executive session, this portion of the meeting will be closed to the public for matters pertaining to trade secrets or financial or commercial information or personal or legal matters or matters whose premature disclosure will frustrate the implementation of proposed agency action. I need a move and a second.
So moved.
By trustee
Second.
Clark, second by trustee Smith. All right, so we'll recess for 2 minutes.
You want a roll call?
Oh, can I have a roll call, sorry?
Trustee Clark?
Yes.
Trustee Clark, yes. Trustee Dorsey?
Yes.
Trustee Dorsey, yes. Trustee Liger? Trustee Liger?
Yes. Yes.
Trustee Liger, yes. Trustee Russell, absent. Trustee Smith?
Yes.
Trustee Smith, yes. Trustee Howard?
Yes.
Trustee Howard, yes. Mr. Chairman, 5 yea, 1 absent.